Right now, there is fear with these prolonged high interest rates, and many think it will destroy their stocks. But it's not high interest rates that will kill your company, your investment. The Fed keeping rates high is not what will hurt your stock, but this will, and that is debt. See, paying too much interest is not why companies default, but it's high debt which can cause a company to not be able to refinance and therefore default. Credit quality and earnings quality are the most important things at the end of the day related to strong measures against default risks. So when EBITDA goes down and leverage goes up, that creates a higher risk of default. Of course, a change in long-term prospects can as well. So I thought it would be fun to look at every credit rating of every single one of my stocks and see how their credit quality stacks up amongst one another. And I highly recommend you all do this too. Now, I have an account with S&P Global and I'm going to use their ratings for my companies. I also invest in this company, and this may just give you insight as to why I feel S&P Global is a necessity and a fantastic investment. S&P Global is just one of 3 main rating agencies, the others being Fitch and Moody's. Now, a few areas of background with credit ratings first before we see the credit quality of my portfolio. Now, credit ratings are forward-looking opinions about the ability and willingness of debt issuers, like corporations or governments, to meet their financial obligations on time and in full. S&P Global has 10 rating tiers they assign, starting with AAA, the highest you can get. This is investment grade, and its extremely strong capacity to meet financial commitments. Then we move to AA, also investment grade, and it's a very strong capacity to meet financial commitments. Then we move to single A. It's still investment grade, and it's a strong capacity to meet financial commitments, but somewhat susceptible to economic conditions and changes in circumstances. Now we move to triple B. Still investment grade, and its adequate capacity to meet financial commitments, but more subject to adverse economic conditions. Now to double B. This is where we go down from investment grade to speculative grade. This is less vulnerable in the near term, but faces major ongoing uncertainties to adverse business, financial, and economic conditions. Then we move to single B, which is speculative grade as well, and it's more vulnerable to adverse business, financial, and economic conditions, but currently has the capacity to meet financial commitments. Now we move to triple C, speculative grade, and it's currently vulnerable and dependent on favorable business, financial, and economic conditions to meet financial commitments. Then we move to double C. This is speculative grade, highly vulnerable, default has not yet occurred, but is expected to be a virtual certainty. So not a good area to be in at this point, probably or below, which we move to single C now, speculative grade, currently highly vulnerable to non-payment, and ultimate recovery is expected to be lower than that of higher rated obligations. Then we move to the lowest grade, which is D. It's speculative grade, and it's payment default on a financial commitment or breach of an imputed promise, also used when a bankruptcy petition has been filed. So there you have all the grades that S&P Global uses. Now let's talk about the main assumptions and principles used to construct the rating methodology used to determine the credit rating. So they look at these things. They look at the relationship of cash flow adequacy to leverage. So higher levels of leverage are correlated to higher levels of default. So obviously this is something they're going to look at. So the higher the cash flows, the better. The lower the leverage, the better as well. Then we look at competitive position, aka the moat. I think this is one of the most important things that I look at when I buy a stock. So it's important to see that they're also looking at this for the credit rating. So the competitive position and strategic position of an industry and company are directly linked to overall profitability, which is related to default risks. They also look at regulatory stability, amongst other things. Then they look at country risk. So where does this company reside and do most of its operations out of? And I see the United States as an economic powerhouse, which is a good thing. Then they look at industry risk. So as an industry, is it one that has volatility, seasonality, struggles with earnings? All those things matter. And then they look at financial instruments. So a lot of financial data basically is what you can get from this. So we're going to start with Microsoft, my first stock, and it's rated AAA, the highest you can get. So that's extremely strong capacity to meet financial commitments. Currently, there are only 2 companies in the United States with a AAA credit rating. Microsoft has impressive financials, has a wide moat business, and has diverse businesses that add a high level of safety. No wonder it is rated the best of the best. Now, I will reveal the other company that has a AAA credit rating in a little bit. Amazon goes one step down to a AA, which is a very strong capacity to meet financial commitments. Amazon has a wide moat and powerful businesses that generate strong free cash flows, especially over the last year. Amazon Web Services is securely in first place, which is that moat, and that produces dependable revenue. Overall, a fantastic company and worthy of this rating in my opinion. Then we have Cisco, which is a AA negative. Now I forgot to mention, but there are intermediate ratings at each level between AA and CCC. So you can think of it as there's going to be BBB plus, BBB, and BBB minus. Think of it as when you're in school and you got a B plus versus a B versus a B minus. All are good with slight variances in strength and in this case, quality. So again, AA is where they fall, just in the minus, and that is still a very strong capacity to meet financial commitments. So Cisco actually has good financials, but it's this company's growth that struggles and why I think it is not rated higher. Then we move to Johnson & Johnson, a AAA rated company, which is extremely strong capacity to meet financial commitments. It's the only other company in the market with a AAA rating besides Microsoft. Fun fact, in 1980, more than 60 public companies possessed the highly coveted AAA credit rating from S&P Global. Today, only 2 remain. That is crazy. Now, Johnson & Johnson is facing many lawsuits, so what gives with this perfect rating? One macro factor working in Johnson & Johnson's favor is that the healthcare sector is highly defensive. As much as we'd like the liberty of choosing when we become ill and what ailments we develop, this isn't a choice we have. Since people continue to need prescription drugs, medical technologies, and healthcare services in any economic environment, it means Johnson & Johnson's operating cash flows tend to be consistent from one year to the next, and it's that consistency that is key. Another reason Johnson & Johnson likely finds itself as a AAA rated company is its leadership. Since its founding in 1886, Johnson & Johnson has only had 8 CEOs. With little turnover in key leadership positions, it means important strategic initiatives are being properly implemented. Not surprisingly, Johnson & Johnson delivered more than 3 decades of uninterrupted adjusted operating earnings growth that was only derailed by the pandemic. So for me, I think Microsoft is far superior of a company, and Johnson & Johnson has been a dud of a performer over the last 3 years, but they do have strong financials and consistency, which S&P Global obviously values. Next, we move to my newest stock, Health Equity, which is a BB, which means less vulnerable in the near term, but faces major ongoing uncertainties to adverse business, financial, and economic conditions. To me, the word regulation comes up, and that's the key factor as any changes in healthcare could negatively affect this company big time. Also, their main revenue source is from health savings accounts, and these are newer to the market, so untested, and I think S&P Global just needs more time to determine its staying power. Of course, this is my brand new stock, so be sure to see my last video on why I am so bullish on it. Then we move to Vici. They are a BBB negative, so they have adequate capacity to meet financial commitments, but more subjective to adverse economic conditions. REITs operate on leverage. Vici is heavily in the experiential industry, which could fluctuate, but let me remind you that this company collected 100% of rents on time during the entire pandemic. They have held a 100% occupancy rate for their entire existence. They also recently became investment grade, so I predict they will get a ratings upgrade over the next couple of years as they continuously prove their ability to grow, diversify, and grow profitability, aka AFFO. So I feel this one will climb the ladder. Now we move to my next REIT, that's Realty Income. They're holding an A-, which is a strong capacity to meet financial commitments, but somewhat susceptible to economic conditions and changes in circumstances. So higher rating than Vici, I believe due to their proven track record. Could they climb the ladder higher? It will be hard because REITs operate on leverage and Realty Income's properties are almost 82% concentrated in retail, so maybe deemed as a little more risky, but they hold very recession-resistant tenants, so that's where its strength comes in, even though it's highly concentrated in retail. I just made a video on how their third largest tenant is closing 1,000 stores. Now, if you watch that video, you will know that I see very little risk. If you want to know all the details, go check out that video I recently made. Realty Income consistently holds occupancies between 98 to 99.9% for the last 32 years. So a proven record, and they are diversifying their properties more and recently acquired Spirit Realty. Overall, a strong rating. Then we move to 3M. They're rated a BBB+, so adequate capacity to meet financial commitments, but more subject to adverse economic conditions. Many may be surprised it is not lower, as this company has been hit hard with lawsuits over the years, but they financially maintain good results overall and are one of the industry leaders. This is a company I do want to sell out of someday. Then we move to AT&T. They go just a hair below because 3M was a BB+. This one's just a BBB. So adequate capacity to meet financial commitments, but more subject to adverse economic conditions. Again, you may be surprised at this one as they hold a lot of debt, but it provides a necessary service and has made smart financial moves recently, like cutting their dividend and a vigorous focus on paying down debt. So deserving, I guess, but one I want to also sell out of someday. Then we move to Warner Bros. Discovery. Again, we're moving a slight step below. We went from BBB+ to BBB. Now Warner Bros. Is BBB negative. So again, adequate capacity to meet financial commitments, but more subject to adverse economic conditions. Again, you may be surprised at this one, as they also hold a lot of debt. There's a common theme, but they are one of the main players in their industry. I also see management showing financial responsibility with focusing on reducing expenses and reducing debt. I could see this company moving up or down from its current position based on future performance. We shall see. Next, we move to Union Pacific. They are rated an A-, so strong capacity to meet financial commitments, but somewhat susceptible to economic conditions and changes in circumstances. Union Pacific is a solid, predictable company that has a wide moat, but is linked to the economy closely as it transports goods. When the economy does well, this company does well. When the economy slows down, so does its shipments. But trains are the most efficient way to move mass products, so they aren't going anywhere. A very solid rating. Then we move to the last one, that's S&P Global. We have to rate them, right? They're the one that provides the ratings. So for this one, I had to grab it from Fitch Ratings, as they cannot rate themselves. That would be conflict of interest, and they get an A-. So a strong capacity to meet financial commitments, but somewhat susceptible to economic conditions and changes in circumstances. I love S&P Global. They are in a triopoly with Fitch and Moody's, provide a service that is extremely important, as we are seeing today, and holds a lot of data. They are somewhat susceptible to a slowing economy and high interest rates, as that puts pressure on bond issuance, adversely affecting their largest profit driver, the ratings business. But regardless, it's a necessary service, and once the economy grows, it greatly benefits this company. So here's the chart now with all my stocks. But one more thing I want to add. We rated all these companies, so I wanted to rate one more entity, and that is the United States government, to see how these companies stack up to a government that we should all be able to depend on. So the news is, though, recently the US debt credit rating got downgraded. They went from a AAA to a AA+. Yes, our US government got downgraded. So again, a AA+ is a very strong capacity to meet financial commitments, but they do fall behind Microsoft and Johnson & Johnson, as you see here on the final look at this chart. So these two companies are rated higher than our US government. That is crazy. Maybe someday the government will be rated back to a AAA, but I think they need to reduce that debt and a lot of other things that I think our government's just really getting out of hand with. So there you have it. Overall, I hold companies in the top 5 ratings and not in the bottom 5 ratings. Health equity is my weakest, but I see huge potential. Be sure to check out my last video I released, as this is a brand new stock of mine and I cover it in detail. Microsoft and Johnson & Johnson are my top 2 stocks and have received the highest of highest ratings. Now, ratings are not everything, of course, as Johnson & Johnson has been an underperformer for me over the last 3 years I've owned it. So I would use these credit ratings as just one of many things you should look at, as stocks' performance is linked to so many various metrics, fundamentals, and outlooks. But don't be fooled that these high interest rates are the reason you should fear your investments. It's rather those that hold high debt that are risky, and this exercise should help you determine the rating quality of your portfolio and maybe help you with future moves and purchases. So let's look at my portfolio and its performance. I'm up over 21.5%. There's S&P Global right there, the company that just provided us all these ratings, and they're up almost 19% for me. I've only held this company for a little over a year, so unlike Microsoft and Amazon that are up over 70-some%, yes, they're in technology, which has really boomed, but they're also very strong companies. I expect S&P Global to be up there in the 70+% gain range someday. But let me know if you have any questions on this portfolio. Again, you saw I hold all these companies in the top 5 ratings, not the bottom 5, and Health Equity is my newest one, and right now it's up 1.9%. So let me know what you think of credit ratings. Since I have an account with S&P Global, let me know if you have any companies you would like me to provide their ratings for you. That is all for today. See you soon. Don't fear those high interest rates, fear that debt, and happy investing.